Today, we will talk about a country with which many of you have trade relations and that we deem to be close and distant to Europe at the same time, Turkey. We have always been monitoring Turkey's political and economic development, even more intensively since the military coup against Erdogan in 2016, and obviously also today, in the light of COVID-19. We have prepared a very rich agenda for today. We are going to take you from the macro environment, the economic development, to the political and banking landscape, down to the nitty-gritty product perspective when doing trade finance in Turkey. So please let me introduce to you today's panelists. I have Gunter Teuber for you. He is designated head of Raiffeisen Research, and he will lead us through the impact of COVID-19 on Turkey's further economic development and on the country's trade relations. Birdem Güneş, Senior Relationship Manager, Institutional Clients and of Turkish origin, will speak about the current political climate and about the banking environment in particular. Also, she will talk about how RBI can support your business in the region. Being herself Turkish and having joined RBI in '94, Birdem is, I dare to say, the most senior banker you can get when talking about Turkey and the country's banking landscape. Our third panelist, Florian Kandelhofer, team head of guarantees, will talk us through the guarantee specifics and which pitfalls you should avoid when issuing guarantees to Turkey. I am Martina Zimmerl. I'm heading the trade finance department of RBI since 5 years now, and I'm your moderator of today. And I will speak about letters of credit, particularly when you are the beneficiary under a letter of credit in Turkey. You will have the opportunity to send us questions via the Q&A functionality during the webinar, and we will answer all the questions that you have at the end of the webinar. The webinar will be recorded, so in case you would like to share it with colleagues, then you can do so, because we will share it with you afterwards. So I'm opening the floor to Gunter Teuber, who will give you an economic update on Turkey.
So thanks for the kind introduction, and I will present you the core facts and views how we are seeing this country also in the broader regional context. So the key messages you can see on the next slide. So we are confident, at least from a short-term perspective, that disaster scenarios can be avoided in the context of the COVID-19 crisis. The country is at least doing okay, but the macro financial position remains very fragile. I will shed some light on this one. The credibility of the macro management is rather weak. We had a weak economic performance in recent years. We see that international banks and financial markets are pretty cautious on this country, and also the political situation definitely carries some question marks. So to start with the COVID-19 situation, you see here the cases in Turkey, and you see at the beginning of the crisis, Turkey was among the hotspots in terms of cases, but finally we have seen after several days and weeks a certain stabilization, and currently the situation is under control. You see also in comparisons to some other larger emerging markets globally or in Europe, Western European countries, where the situation had been more challenging. So the COVID-19 crisis at least seems to be under control. And more interestingly, as it is shown on the next slide, Turkey managed to deliver this performance with a rather interesting, I would say, lockdown strategy, only targeted lockdowns during certain weekdays. You see this activity data here on this slide, and you see that we haven't seen such a harsh lockdown like in some Western countries. And currently, the mobility data in Turkey are indicating that we are close to pre-crisis levels. This mobility data also go well, and I would say on the next slide, it was already shown, this mobility data go well in hand with the economic data. So sentiment was hit by the global crisis, as it is shown with the PMI here at record low levels. But Q1 GDP data in Turkey had been still okay. The downside is to come also here in Q2, but at least the start into the year was okay compared to hard hit euro area or some other countries. So that's why we are not too negative also on the near term economic performance, given that Q1 was still okay. However, you see also on the PMI on the left-hand side, Turkey was already in stagnation or recession in the previous years, and definitely this will contribute also to a more challenging situation going forward. So for next year and this year, if you go to the next slide also, we expect in Turkey GDP drop in the range of -3 to -4% this year, little bit less severe than in the Western world. As I have shown, the Q1 was still okay, Q2 will be bad, and there is a chance, given that the situation seems to be under control, for a certain recovery going into the next year. But what you see on this chart, and this is characterizing more for the long-term development, Turkey has one of the highest growth or macro volatilities in the global EM space, and this is already pointing to certain challenges we have in terms of the macroeconomic management, and that we had serious crises already in the past compared to other EMs, and that we had already a self-inflicted crisis also in 2018, 2019. The situation will remain challenging as the unemployment rate will inch above the 10% level going forward. We expect something like 13% plus, which is definitely challenging for an emerging market with a rather young population. So if we move to the next slide, we see also what is the drawback of this high macroeconomic volatility. If we look at the core markets of RBI in Central Southeastern Europe, you see we had a nice income catch up over the last 10, 15, 20 years. You see de facto Turkey is in stagnation over the last 3, 4, 5 years compared to the income levels in the Western world, also matching more or less the rather disappointing performance of the Russian economy from a longer term perspective. But what is outstanding in case of Turkey, and you see this in the chart below, we had not so, I would say, a supportive economic performance, but the country was increasing its leverage. External debt was going up from 400 US dollar billion in 15 to currently 450. So this also points to a weak economic performance and efficiency, because you take out more debt, but you don't generate growth, and the external debt load is substantial. While during the same period of time, the FX reserves in Turkey decreased substantially, pointing also to continuous FX interventions. So currently we just have 50 billion net FX reserves. This is roughly 3 to 4 months of import coverage. This is very at the low end of the EM competition. And you see the economy and the system is not able to deliver sufficient growth. If we move to the next slide, we see also that Turkey is undergoing a certain reorientation in terms of its economic integration. You see, since the beginning of the 2000 years, the share of the EU in terms of imports and exports was declining. It's still substantial, and this reorientation is also mirrored on the FDI side. You see that 20 years ago, roughly 70% or 80% of FDI was coming from the EU, even 10% from the US. Currently, the EU is just 60% of the FDI stock, the US close to 3%, while definitely investments from the Arab space have increased. This also explains why Turkey now currently in a more challenging situation is looking for support in the Arab world, got some swap lines also from Qatar, but not from the Fed yet. And this partial disintegration with the Western world is definitely currently not so supportive. And we have to be careful that also, for example, Iran is among the top 20 trading partners in Turkey, which is sometimes also a little bit of point of conflict when it comes to geopolitical questions. But a certain disintegration with the Western world in the EU, also in the economic space, still of importance. So if we go to the next slide, we see that Western banks are already rather cautious on Turkey since a longer period of time. So since 2015, exposures of Western banks on Turkey decreased by roughly 35%. This is in contrast to the global EM picture, where exposures were still increasing in recent years. And this comes close to what we have seen in Russia in terms of deleveraging by external banks. But we know that Russia is definitely under tough sanctions. In Turkey, there are no sanctions per se, so it's more market skepticism. And you see that especially US and UK banks also taking here US exposures into account, decreased their exposures towards Turkey decisively over the last 2 to 3 years. So there's a cautious stance of international banks towards Turkey, but the exposure is still sizable. So the international banking exposure is still above 20% of GDP in case of Turkey. This is still sizable, but a deleveraging in recent years and the cautious stance of the international banks. So if we move to the next slide, we see also what is behind the cautious stance. So the Turkish lira is one of the weakest currencies in the EM space from a long-term perspective, underperforming emerging market currencies since 2018 substantially. Some of the other EM currencies, as it is shown on the right-hand side, also got a hit, but definitely a challenging FX performance driven by weak macro management and creating also challenges for the domestic banking sector. And this also explains the cautious stance of international banks and companies towards Turkey. And it's not just the FX market. If we look at the next slide, we see that Turkey is definitely facing a huge discount or maybe distrust on international markets. In the local currency space, you see that the bond yields are well above the 10% level, well above similar rated peers. On international markets, we could even say that Turkish bonds are traded closer to distressed territory. You see since 2017-18 moving up to what is the country risk premium for Ukraine. And definitely we all know that Ukraine is definitely also one of the more challenging territories in Europe. So there is a huge mistrust on markets and risk repricing. And this is a challenging situation for the central bank. As you see also on the next slide, Turkey had been forced into emergency rate hikes in 2018, is still facing one of the highest interest rates in the emerging market space. This contributes to domestic pressure on the central bank, but given this market distrust, these high interest rates are needed. And you see also here on this slide, even compared to Russia, which had been also faced into emergency hikes in 14 and 15, the situation in Turkey is extreme and it takes much more time to come back to normality. So this is definitely challenging the central bank that they have to sustain those interest rates on the domestic political agenda. And what is even more challenging, you see on the next slide, the reserve topic I mentioned. So it's not just about the weak gross reserves, but the net reserves of Turkey. And Biadem will speak about this later on as well. But the central bank is supporting state banks with FX to support the lira via FX swaps. So the net reserves in Turkey are possibly 20, 30, or even lower, 10 US dollar billion currently. And with a short-term debt load of 170 US dollar billion, this seems to be a little bit of an unsustainable situation and explains the huge mistrust on markets. And the weak economic performance, the challenging macro management deeply pushed the Turkey country rating into the junk territory in recent years, as you see here, and we don't expect a quick turnaround here. And definitely this explains that pricing and bank exposures to Turkey are definitely currently under pressure. So if we move to the next slide, you see also once again Turkey in the EM space. So you see the increase in leverage in recent years and also the, I would say amount of leverage in absolute terms. So government and non-financial corporate debt at close to 100% of GDP. It's not the worst among the emerging markets. So the situation looks to be manageable, but definitely we have a limited credibility of the macro management. The coup that was mentioned and the brain drain at relevant institutions like the MinFin and the central bank limits the market credibility currently. And we have, I would say, a certain increase in political uncertainty. The weak economic performance also creates some concerns that maybe we have to go for new elections, or that we may see also a more united opposition going forward. And definitely a power struggle in Turkey is not what would add to a more stable situation given the macro challenges I sketched. So now I hand over to Birem to show us even more details on the challenges we have and how the macro situation plays out for the banks.
Thank you very much, Günther. Also from my side, very warm welcome to our today's webinar. I would like to give you an overview on the Turkish banking system and on its major players. Actually, when you look at the country, one of the most important institutions you have to take a closer look is the country's central bank, and especially its reserves. Now, the role of a central bank is normally to be in charge of setting the official interest rates, implementing monetary policy in order to manage inflation, exchange rate of a country, controlling the money supply of a country. What central banks currently are doing worldwide is monetary easing. So why Turkish central bank shouldn't do it, right? Now the problem in Turkey is that the country is in a high inflation environment, and this for a very long time. The inflation is around 10–11%. The forecast for 2021 is 10%. And on top of that, whenever the Turkish economy is growing, it is producing current account deficit. You know, Turkey is an oil importing country. It needs to import raw materials from abroad. So it is the current account deficit is always under stress. So unlike developed countries with a very low inflation rate, monetary easing, I mean cutting rates, is helping, but in case of Turkey, where we have a high inflation, it is not helping to bring inflation under control. So the main weakness is that Turkey's growth is not sustainable, and you can see there is a high correlation between high GDP, high loan growth, increase in external borrowing, and increasing current account deficit. So the aim of Mr. Erdogan, of President Erdogan, is to reduce the inflation, boost the economy, stabilize the currency. But the thing is, he believes that the lower the interest rate, or with the lower interest rate environment, business and capital expenditures will increase, and with a higher interest rate, this will lead to a higher inflation. So in order to achieve this target, we see that decisions taken by the central bank with regards to monetary easing are very much dictated by the government. And here it comes. This is where we see that the central bank and main authorities in Turkey are not acting independently. Now, the problem is that with a low interest rate environment, you remember the current policy rate was in Günther's presentation, is currently 8.25 versus an inflation of, let's say, 10–11%. So what are Turkish savers doing? If they would save their money in Turkish lira, actually their money would lose value. So what are they doing? They're shifting their savings towards FX or give gold deposits. So this leads to, we call it dollarization. This means Turkish lira deposits decline. And even these Turkish lira deposits have a very short duration, less than 3 months. And consequently, also the banks there is no much money left for the banks because they have less Turkish lira deposits to lend further back as loans to the markets in Turkish lira. So it is rather increasing the FX demand. People are changing their Turkish lira, exchanging their Turkish lira in FX, which is even further weakening the Turkish lira. So since the beginning of 2020, the Turkish lira lost again value by around 15%. So the last peak we saw was in 2018, where the Turkish lira depreciated by more than 30%. So what else is Central Bank of Turkey doing? It is funding the fiscal deficit. And how is this can be done by printing Turkish lira? I mean, this is nothing exceptional or something new. The ECB is doing this, Fed is doing this, especially in crisis times. They are doing this, and it works like this. The government is running a fiscal deficit. I mean, currently 6%, let's say, of the GDP, and to cover this deficit, it is issuing bonds, and central bank is buying them. So this is quite normal. But in Turkey, things are different, because central bank is not only funding this fiscal deficit and the banks by printing Turkish lira, but at the same time, it's using its FX reserves to stabilize the currency. So it is increasing the money supply to the market, hoping that it will go to consumption of goods, to service, to boost the economy. But if you keep printing money in a with a weak currency, this will lead to an increase in the current account deficit and will lead to an increase in inflation. So over the last years, we have seen it in Gunta's presentations. The central bank has unfortunately used a lot of its FX reserves to defend the Turkish lira. Over the last 12 months, central bank has lent FX through swaps to state banks, which they have sold on the FX market to keep the Turkish lira stable. So a huge amount of the FX reserves central bank had in its own portfolio went outside of the country and will most probably, especially nowadays, not come back. I mean, taking into consideration the virus and less tourism, so this FX will not come back very soon to Turkey. When you consider also the short-term foreign debt payments of the Turkish banking system and corporates, in the next 12 months, there is an estimated short-term debt payment due of around $170 billion. So that's why the FX reserves of a central bank are very essential, because the central bank is always the last resort of a country. So hopefully corporates and banks will be able to repay their debts. So overall, to say is, we have an inflation, we have monetary policy and currency crisis, and that's why Turkey is very eager to get additional swap lines from other central banks. Günther mentioned already they were successfully tripling an existing 5 billion swap line with the Central Bank of Qatar to 15 billion. This was a very good action. And now ideally another 15-20 billion with another renowned major central bank, like Central Bank of China or Bank of Japan or Bank of England, a good name. If they would be able to get another swap line, this would help the central bank's net reserve position a lot. So another authority in the banking system is the banking regulator, partner in crime. Well, I mean, they have just blocked 3 foreign banks from FX transactions with Turkish lira in order to protect the Turkish lira from the depreciation. Again, here, this institution or these authorities are again acting on behalf of the president and not in an independent way. What else are they doing? They are changing swap regulations constantly and changing the bank's required reserves ratios, how they are calculated. They have just recently introduced a so-called asset ratio where banks are forced or need to borrow a certain percentage of their deposits. Again, a measure to force banks to lend and to pump more money into the economy. Also, additional tax burdens. For example, there was last month a tax on individual FX and gold purchases was increased. It was 0.2%. This was increased to 1%. This means that every time a citizen is exchanging FX, this higher tax applies, and there is even a waiting period of 24 hours in case you want to buy gold in a bigger or bigger than a certain amount, and during these 24 hours, your background is investigated. So again, the objective is to punish people who are not depositing their money in Turkish lira and to prevent the further dollarization. So whenever the President Erdogan is complaining that especially private banks are not committed enough to the economy, they are burdened with more regulations. Now, how are banks dealing with the situation? I mean, it's obvious that state banks, they have no other choice. Their loan portfolio grew by 30% year on year. And this is, of course, increasing the systemic risk. And in order to keep, when you grow on one side, you have to have also the necessary capital. So in order to keep also the necessary capital levels, they have received capital injections from the state already. With private banks, it's different. They are known as acting as much as possible prudent and very conservative, and they are still trying to keep their independent decisions. When it comes to their lending activities over the last years, they have acted quite selectively. They tried to expand their credit lines more or less for existing and stable clients. They understood that in times, especially of an epidemic crisis, credit indebtedness is high. And in the absence of credit guarantees, there is a very high likelihood that these loans will not be repaid. So in order to comply, for example, with this new asset ratio, we had a couple of interviews with top-tier banks, how they are dealing with this asset ratio measures. They have already precautionarily started to change the denominator of the ratio by counterbalancing their appetite for FX deposits. So the rates for the interest rates for FX deposits are not so competitive anymore. Actually, they want to reduce the FX deposits. And they have started to invest more in government bonds, and they have increased their FX swaps with central banks. So in order to balance this ratio, and actually all of them are already in line with this requested asset ratio. When it comes to swap transactions, which they have to conclude with central bank, of course with worse conditions than on the international market, their earnings, of course, are affected, and which also forces them to for higher provisionings. So unlike state banks, they have other obligations. Their obligations are towards their shareholders. We will see then later on. I mean, almost half of the top tier banks in Turkey have foreign shareholders. So they have their obligations towards the shareholders. They need to keep sufficient capital buffers. They have to generate sound earnings and with a very conservative provisioning, and they are trying to avoid any deterioration on their balance sheets. So this is actually an overview of the most important players and authorities. When we go to the next slide, we will see there are also quite positive strengths of the banking system in Turkey. First of all, very young population. More than half of the population is under the age of 34. The banking system is highly digitalized, highly technology-wise advanced. This is necessary to meet the requirements of the young people. Unbanked population, more than 40% of the adult population. So the Turkish people like to keep their gold reserves or money under the pillow. So there's still room for development here for the banks in Turkey. The banks are strictly regulated, Basel III compliant, strictly monitored. In 2001, the Turkish banking system went through a big crisis, and since then they are strictly regulated. So the Erdogan government took over actually a very strong banking system when they took over power. Banks are highly liquid, so 60% of the assets are funded by deposits, and they have sufficient fixed liquidity buffers, as we have just explained. And all this is sufficient to cover short-term liquidity shocks. So up to 12 months, no problem for Turkish banks. They have no open FX positions. Turkish banks are not allowed to keep more than 25% of their capital as short-term positions. So banks are hedging their FX positions, mainly with the central bank. And they have a relatively sound asset quality. NPLs, for the time being, 5%, and stage 3 coverage ratio, these are non-performing loans, is around 70%, actually quite good and high. And also strong solvency. The capital adequacy ratio is in average of around 18%. The CET1 ratio is around 76%. So all these figures are, I mean, for a lot of, for many Western banks, these are dream figures actually. So when we go to the next slide, we see the risks of the Turkish banking sector. Now it becomes a bit more interesting. As we have mentioned, the short-term deposits, average duration is between 1 and 3 months, actually 1 month, around 1 month. Reason is also, we have seen in Gunta's presentation, I mean, people have not much left actually from their earnings to save. There is a very low savings rate in the country, which is also one of the fundamental problems of the economy. And also it is quite, the GDP per capita is actually quite low. That's why always short-term deposits. This is one of the negative effects on the Turkish banking sector. They are depending very much on short-term FX funding, on short-term FX denominated wholesale funding. I mean, despite the banks have reduced their FX external debt since 2018, there is still a refinancing risk for Turkish banks related to the effect of the pandemic crisis, the weakening of the Turkish FX reserves, and yeah, most banks have continued to access external funding markets so far in 2020. They were able to roll over the short-term international syndicated loans, although with lower rollover rates, around 70–80%, but also due to limited appetite for FX lending. Remember, the banks are full with FX deposits. Overall, we see a reasonable coverage of their FX debts. However, if there would be any change in the stability of the deposits, any movements in the deposits, continuing coronavirus, I mean, we do not know whether a second wave will come. This will have an effect, also, of course, the weakening in confidence and so on, and this will have an effect on the FX funding, and yeah, we will see how this will develop. FX liquidity, as I mentioned, they have currently enough for a 12-month complete shutdown of the market. Their liquidity is mainly largely placed with the central bank. They have to keep liquidity buffers, and they are doing FX swaps with and placements with the central bank. If you also add on cash and interbank placements, they have overall sufficient buffers to cover both their maturing FX wholesale liabilities and also on top of 10 to 20% of their FX deposits. Nevertheless, if they are going to face a longer market closure and FX deposits leaving the country, this could hit also the bank's liquidity position. So the next point is asset quality. Although capitalization remains adequate at banks, they had a strong first 2 months in 2020. Their first quarter results are quite good. But the impact on this coronavirus on their asset quality will likely to be seen in the fourth quarter of 2020 and for sure in 2021. Of course, the risks on the bank's capital positions have increased as the operating environment has weakened. Markets are volatile. The Turkish lira depreciated since the beginning of this year, and a higher stage 2 loans are seen on their balance sheets, especially state banks. They grew rapidly on the loan side. We have mentioned before, they are forced to lend much more to the economy. And banks' exposures to, right now, due to this crisis, critical industries like tourism, automotive, aviation, construction, real estate, energy sector are, of course, highly affected. We have seen a fall in the exports, fall also by 40%, also fall in the imports, a decrease in the GDP, high unemployment, new asset ratio requirements. All these are forcing banks to increase lending in a stressed environment. And this altogether would have an effect on their asset quality. What we have also mentioned is the regulatory interference. Central bank, just a very hot topic. There was just recently the advisor of the president was appointed as in the supervisory board of Vakıf Bank, one of the bigger state banks. Central bank fixed reserves we have mentioned. What else can we say? So we will see how things will develop. They would certainly need other swap lines from other central banks. So when we come to the next slide, you see here that the overall banking system, the asset size of the banking system, and that there is a very much, there is a concentration around 80% of the total asset size is concentrated on the top 10 banks. The top tier banks in general are performing well. But the current pandemic crisis environment will have certainly negative effects on all banks' asset quality, on their earnings, on their performance, on their capitalization, and funding and liquidity profiles. Although the shares of the FX deposits remain quite high, weak confidence in the lira due to high inflation, local currency weakness, political uncertainty, all are these are the dangers which are expecting them. When we look at the state banks, Ziraat, Halk and Vakıf, they are of systemic importance. There is a commitment of the government, and they have already injected further capital and are ready to inject further capital if needed. On the other private banks, you see some of them are foreign with foreign shareholders. AK, İş Yapı, Kredi Garanti, all of them, they have significant capital and foreign currency liquidity buffers. I would say the asset quality risk is especially on the state banks, as they grew rapidly and more rapidly than the private banks. So, and the last presentation, or the last slide, is actually what we can offer as RBI. Certainly a deep market knowledge and close monitoring. I'm Turkish myself, and I'm covering the Turkish market since 16 years already. We have Turkish speaker product colleagues in the bank. We are covering, we have a wide coverage in Turkey. We are working with more than 30 Turkish banks, including their subsidiaries. And with subsidiaries, I mean their bank subsidiaries, not their leasing or factoring companies. With them, we had close relationships in the past, but not right now. RBI is preferred trade finance partner in Austria for Turkish banks. According to SWIFT data, 50% of their export LCs in 2019 from Turkey to Austria was covered by us, by RBI. We are able to structure large transactions. We have several mitigation channels. We are using the secondary market, and we are able to structure bigger transactions, and also are able to react to any market deterioration, changes in the risk profiles. So the thing is, of course, we have an extremely dynamic limit situation for Turkey, and not only to the head office, to Vienna, but also trade finance flows from Turkey to our network bank countries. We are coordinating everything out of Vienna. We have a local presence. We have a very successful merger and acquisition advisory office of our Raiffeisen Invest in Istanbul, very successful. And we have also a correspondent relationship with major Turkish banks. They keep their euro account, but also other FX denominated accounts with us. So we have not only the account relationship with the banks through these accounts, but we are also, as RBI, acting for Western major big names, where we act as their intermediary bank for customer payments from Western countries towards Turkey, because of our large network in Turkey. We are active lenders in the syndicated loans. We are very well known on the syndicated loan market for Turkish banks. We almost never left the market. These are relationship transactions, very important for Turkish banks to show the commitment from foreign banks towards the Turkish banking system. We are also able to fund, and we are doing and currently have a large portfolio on our books, asset-based finance transactions, longer-term transactions for Turkish banks. And last but not least, we are active, of course, on the treasury side and on the FX business, and also Turkish banks are placing the money market at RBI. So actually, I hand over. This was my part. I hand over now to Florian to go a bit more deep in detail what we are doing on the trade finance side in Turkey. Thank you very much.
What we do now is we get into the nitty-gritty details, as you already said, for our trade finance products, namely guarantees and LCs. I'm going to cover the guarantee part first, and then Martina Zimmerl will continue with the LC specifics. And the purpose of the guarantee section will be to show you different options that you have available for getting a guarantee issued in favor of Turkish beneficiaries. And this will be accompanied by Turkish country specifics and by what the beneficiaries' expectations are in connection with different guarantee options and how much they cost. So basically, we want to give you a decent amount of information, which hopefully is useful for you when you want to discuss the issuance of a guarantee for a Turkish customer of yours. So as I said, the guarantee section is designed around a situation where you have concluded or you intend to conclude a contract with a Turkish customer, and the contract requires the issuance of a bank guarantee in their favor. So if you are the seller, it could be a performance guarantee or an advance payment guarantee that you have to provide. And if you are the buyer, it could be a payment guarantee. Or if you're in a pre-contract stage, it could be a bid bond, it could be any type of guarantee. And the most convenient way for you to arrange the issuance of a guarantee would be what I call a plain vanilla structure. It's basically the simplest form of getting a guarantee issued. It looks like that. You are the guarantee applicant, you place a guarantee issuance order with your bank, and your bank is the guarantee issuer, and they issue the guarantee according to their standard wording, and they send it directly to the Turkish customer. There is no Turkish bank involved, and We have observed that this plain vanilla structure is seemingly not accepted by Turkish beneficiaries. We have made this observation from our historical guarantee portfolio, where this plain vanilla structure is almost non-existent. And the circumstantial evidence is that Turkish beneficiaries want a Turkish bank involved. So I suggest you are prepared to include a Turkish bank in any guarantee structure as well. So now, how can we get a Turkish guarantee involved? For example, by choosing an indirect guarantee structure. We have the same parties as we had before. We have you, your bank, and the Turkish customer of yours. And we also have, obviously, a Turkish bank who has replaced your bank as guarantee issuer and who issues the guarantee in its own name and sends it to the beneficiary. Your bank, on the other hand, has become the counter guarantor who is not visible to the Turkish customer and who only instructs the Turkish bank to issue the guarantee and issues a counter guarantee in favor of the Turkish bank. The Turkish bank is either dictated by your customer or you can choose it on your own. And in any case, the Turkish bank and your bank, they will need to have a banking relationship, and the Turkish bank will need limits for your bank, which are sufficient to accommodate the guarantee. Since the Turkish bank now acts as the guarantee issuer, you will be confronted with a situation that they charge also their guarantee fee. And this is something that the customers usually ask: how much do guarantees cost in a particular country if we use a local bank? For Turkey, we have made this observation. We see that, at least for us, guarantees with a validity of up to 1 year cost 0.8% PA, and for 3 years, they cost up to 1.2% per annum. This is not particularly cheap, I have to be very honest. And it's, of course, advisable that you contact your bank and ask them to obtain a range of offers from various Turkish banks so you can pick an attractive offer, because there is some room to improve the pricing, but it can also be more expensive. So 80 basis points and 120 basis points is just an indication of what you can expect. And there is also a 5% guarantee fee tax. It means the tax is not payable on the guarantee amount, but it's payable on the guarantee fee. The Turkish bank, which is quite convenient, they collect their guarantee fees in 3-month intervals from the issuance date until the expiry date of the guarantee. As promised, I want to give you some Turkish country specifics that apply specifically to indirect guarantees. Now, the first thing that comes along with indirect guarantees is a language restriction. The reason is that Turkish banks are required to issue all their domestic guarantees in Turkish language, except for bid bonds, which they are allowed to issue in English language if there are bidders from outside Turkey. In practice, we see that the Turkish banks, they will issue all kinds of guarantees in English language, but only in case your bank gives them a very broad undertaking to indemnify and hold them harmless for all consequences arising from the use of the English language. And by judging from the wording of these indemnities, it appears to me advisable to rather stick to a Turkish guarantee text, because this is the way it is supposed to be. So in case you negotiate an English version of a non-bid bond guarantee, you should ensure that a competent Turkish translation can be provided. Another thing, another country specific, is that the Turkish beneficiaries and the Turkish banks expect that you pay them delay interest starting already immediately from the date of receipt of their demand. And this is expected even if the guarantee or counter guarantee allows a certain number of days for payment after receipt of the demand. This is unusual insofar as the delay interest becomes payable despite that there is no actual delay in payment. My opinion is that these clauses can be accepted because, firstly, the demands rarely happen, and secondly, such interest would only be payable for a small number of days, and therefore the impact is rather negligible. Anyway, you will find these delay interest clauses everywhere. You will find them in special wordings for public sector beneficiaries, and you'll find them in even the ULDG standard wordings of the Turkish banks. You find them everywhere, and the Turkish beneficiaries are used to having these delay interest clauses. Okay, speaking of UADG standard wordings, the Turkish banks are among the most heavy users of UADG 758, and they have available a UADG version for most guarantees, with the exception of guarantees for public sector beneficiaries, which require a special non-UADG wording. And this is rather convenient for drafting guarantee wordings, because the UADG, they offer a common framework with whom everybody can work easily, because it's widely used. And maybe on a smaller side note, we see that some Turkish banks try to agree with the counter guarantor, who is your bank, not to transmit to them a copy of the payment demand when they receive a payment demand under their guarantee. This is something that not all Turkish banks do, only a small minority does it. And it's a business decision. It's not rooted in any law, as far as I can see. And you would see it written in the counter guarantee text. So if you see, for instance, that Article 22 shall be excluded of the UADG shall be excluded from the counter guarantee, you know that the bank will not want to send a copy of the payment demand to your bank, and therefore your bank cannot send a copy of the payment demand to you. So please be aware of that. And if you don't like this approach, then you should choose a different Turkish bank. So with the indirect guarantees, we have some challenges like the language restriction or the additional fees. So if you want to avoid that, you can agree with the beneficiary on a direct guarantee with a Turkish advising bank. It means that the guarantee is still issued by your bank, and it sends it electronically to the Turkish bank, and the Turkish bank just prints out the guarantee and they send it to your customer without assuming any obligation, except for confirming that the guarantee of your bank is authentic. And from our guarantee portfolio, we see that this is actually a acceptable alternative to the plain vanilla guarantee issuance where there's no advising bank. And the fee charged by the Turkish banks is quite small. But you can have it for 100 euro plus SWIFT charges. It comes for 150. It can vary a bit, but it will, in any case, it will be a flat fee, and it will not be too expensive. Okay, now this is my last slide. When you choose this kind of guarantee, of course, your bank will issue the guarantee. Because not the Turkish bank will issue it, your bank will issue it. And the Turkish beneficiaries, they are familiar with UADG 758. As I said, the Turkish banks use it a lot. So the beneficiaries in Turkey are familiar with that, but some of the Turkish beneficiaries, they insist on guarantees that are subject to Turkish law. And that can have some traps. And one of the biggest traps or risks is the expiry date, namely the way it's written, or the way it is embedded into the guarantee wording. If the guarantee wording says, for instance, that the guarantee is valid until a certain day, full stop, then the payment demand can be sent for 10 years after the date if a breach of contract has occurred within the stated expiry date. And this can be avoided only if you add or if you state that the guarantee will become automatically null and void after the expiry date. So this is very important. The Turkish banks have confirmed to me that this is still the case. So watch out if you don't use UADG, if you only use Turkish law. And finally, another general observation is the ratio of guarantees to SPLCs in favor of Turkish beneficiaries. So if you are particularly fond of using SPLCs, some beneficiaries in Turkey accept them, but only in the private sector. In the public sector, they are not accepted. And generally, guarantees are much more common in Turkey. So you rather should plan to issue a guarantee. Okay, now my last final thing is I want to give you an idea what is more acceptable, indirect guarantees or direct guarantees with an advising bank. And in our historical guarantee portfolio over the last 2 years, we looked at it, we see that half of the guarantees that we have, they have been issued as indirect guarantees, and the other half have been issued as direct guarantees with the Turkish advising bank. So the chances are quite good that your customer will also accept a direct guarantee, which is cheaper. Okay, then I want to thank you very much for your attention, and I hand over to Martina Zimmerl.
Thank you very much, Florian. Our last point on the agenda, and I know that we have already exceeded the limit, yeah, so I will try to make it short. Yeah, I move now again to the risk perspective, namely the export LC perspective, where RBI, as your bank of choice, confirms a letter of credit that has been issued by a Turkish bank. And you may ask, why is this relevant? Yeah, because Turkey is still a strong LC country. Yeah, believe it or not. Yeah, but last year Turkish banks issued 42,739 LCs with a total volume of euro 25 billion. And despite the fact that letters of credit globally are going down, with respect to Turkey, the volume has gone up, namely 6% year on year compared to 2018. So this is also a sign that obviously the economy is fragile, yeah, and that, as mentioned by Birdem and also insinuated by Gunther, what is really very good and solid, or at least better than on the rest of the economy, is the Turkish banks. Yeah, and RBI continues to have confidence in the Turkish banks. Yeah, particularly if we speak about transactions up to 1 year. Yeah, if it's longer transactions, then obviously we have to look more into the risk that we're covering. In general, as mentioned by Birdem, our limits are quite well utilized, and we have a quite good flow. A large part of the LCs are issued with instruction confirm. Yeah, and I can also tell you that on the product side itself, there are no issues, yeah, because there is an excellent product knowledge of the Turkish banks, yeah, and as you know, the rules, international rules are applicable, so there is not much to discuss on the instruments themselves. But what is quite interesting is that at least with RBI, 80% or 90% of all the LCs that we confirm from Turkey are also discounted. Yeah, so it's mostly deferred payment LCs that we're doing. Yeah, and then you as beneficiaries, you are discounting them, and here you have different options. You can sign a separate discounting agreement with RBI. Yeah, or alternatively, you can agree with with the applicant that the discounting optionality is already included into the letter of credit. And this is something that we see actually as a quite specific on the Turkish market, that Turkish banks like to have this discounting option already embedded into the LC wording. Another option to provide financing to Turkish banks or applicants is the LC post-financing, where you have not a deferred payment LC, but a side letter of credit that then we as correspondent bank of the Turkish bank are being financing. But I would like to come back to this optionality that we see quite a lot on the Turkish market, namely where the LC wording already contains the discounting of
Martina, you are muted.
Yes, I understood that. You heard what I said until now, right? Yes, good. So why do I recommend it to you? Because it's actually something that is used on the Turkish market. Yeah, it's an easy handling process because the letter of credit is issued as a deferred payment LC, and in the special conditions there is a saying that the LC may be discounted by presentation of documents, and only by that additional condition, and without you as beneficiary having to sign a separate agreement with RBI, we may easily and efficiently discount this letter of credit and give you the benefit of having the funds up at the side, while your counterparty in Turkey as applicant has an extended reimbursement obligation towards towards his bank, meaning that he has a deferred payment obligation towards his bank and towards us. Yeah, that this is the beauty of the instrument, and as said, compared to a discounted LC where you have to sign a discounting agreement, it's a quite easy handling process, and it's something that we regularly see on the Turkish market. With this, I would conclude the official presentation, and I would like to pass to the Q&A section. I have one question, namely, this is to you, Florian, so please unmute yourself, and I would kindly ask all the participants now to unmute themselves. Yeah, Florian, would RBI issue a direct guarantee under Turkish law?
Yes, we would issue a guarantee directly under Turkish law. We have to say it is maybe better to use a Turkish bank, but we educate ourselves a lot. We visit the Turkish banks, we go to conferences, and this is why, for instance, we knew about the expiry date issue. It can bear risks, but we generally do it. As long as the text is fine, we will be happy to do it.
Mm-hmm. Then I have a question I cannot answer up front. Maybe Birdem, you can help me. It's a tricky one. Namely, do you know what is the average LC issuance premium for a Turkish private company? Well, having been a corporate banker myself, I know that this is very much risk-based. Yeah, namely, it depends on the rating of the respective corporate, and I would assume that this is the same for Turkish corporates. So this can, at least within RBI, range from 20 basis. It obviously also depends on the tenor, but it can range from 20 basis points to more than 100. So I'm really sorry, but I cannot give you a qualified answer on that one. But Birte, maybe you can help, even though I doubt it.
Yes. Yes, Martina, this is also I cannot clearly tell you this, but for sure there is a premium and according to the risk. But exactly the percentage I cannot tell you.
Yeah. Gunther, I have one question for you, namely, what are your expectations with regards to the EU-Turkey economic relations? That's an interesting one.
Yeah, I think I have sketched that at least the relations are not growing substantially in recent years in relative terms. But on the other hand, we have the German EU presidency in the second half of the year. We have some indications that they want to at least push forward once again a little bit some discussions with Turkey, also on the customs union. And so let's see. Yeah? And overall, in terms of external trading partners, Turkey is still the 5th largest external trading partner of the European Union. Definitely a relative decline, but as I have shown, the EU economy is still very important for Turkey. And hopefully the German EU presidency will deliver on the promise to do a little bit in the second half of the year. I think this will be also beneficial for Turkey, honestly speaking.
Thank you, Gunther. Birdem, I have one for you, namely, do you think that Turkey is becoming a more Islamic country?
And this is also an interesting question because I think from Western perspective, it always looks quite, quite strange, and Turkey looks as if it is more and more moving to an Islamic country. But actually, I do not think that this will happen. I mean, the Turkish Republic was built approximately 100 years ago, and it is a secular country where politics and religion is completely split. And although the Erdogan government is quite pro-Islamic, and their way of living, their ideology is more Islamic, nevertheless, the Turkish population sticks on its, Western civilized, framework, and I do not think that this will ever happen. I mean, 99% of the population is Muslim. It's a Muslim country for sure, but you cannot compare it with, I don't know, Iran or Saudi Arabia. There, the jurisdiction, the legal framework is according to the Quran. This is not the case in Turkey. Of course, I mean, you have seen it's a very young population. Depending on their beliefs, young people there might be also covered, young women. But at the end of the day, it's an internet society, and they are all used to live a modern life, and that's why I do not think, and on top of that, the more the government is squeezing people or pushing more towards Islam, closing, for example, schools and building up mosques, the more the people on the street are pushing towards a Western life and stick to Atatürk's beliefs. And that's why I do not think that it will become ever a real Islamic country in that sense. Yeah.
Birdem, there's another one for you. What is RBI's pricing for a one-year LC confirmation for Prime Turkish Bank?
You want to disclose
give away our pricings, yeah.
You want to disclose this now, yeah? Yeah, it depends. It depends. It really depends on the amount. We are our majority. I mean, mainly we are serving our own corporate clientele. So the beneficiaries are always our clients. And of course, it depends on the volumes, but I would say it would range between, and depends, of course, on the counterparty itself. But when we talk about top tier Turkish banks, I would say it's between 125, 150, depends how things develop, availability of limits, the size of the transaction. It's around this or in this range, I would say.
Yeah, I think
I'm ready
we can
for negotiation. We can discuss in detail.
Exactly.
So it depends how much
Obviously, if it's a small transaction, it will be higher, yeah, because the internal efforts are also priced into that one, yeah.
Yes, and also on the trade flow. Yeah, it depends on the flow, on the expectation, how much transactions we will receive, and this can be seen then as a package.
Yeah. Good. We have somehow already breached our time, yeah, so we have to come to an end. So I would like to conclude that webinar with this last question, and I would like to thank all of our panelists today, and also the colleagues behind the scenes, Herbert and Raphael, that helped us organizing the webinar. I sincerely hope that you liked the webinar. And that you got out of it new information or new perspectives that help you to do the business better in Turkey in the future. You know, we are your partners, and we are happy to support you here. Please don't hesitate to give us feedback. Yeah, if you like this format of going from the macro perspective down to the product. Yeah, because if you like it, then obviously we will be happy to repeat that also for other markets. And there will be a recording of today, yeah, that we will be happy to share with you, so that you can then also forward it to your colleagues. And once again, I would like to thank you for the interest. Take care, and most importantly nowadays, stay healthy. Thank you.